Hello traders, welcome back to new video in our exciting series. I am Sanjay from Tribe International and I am thrilled to continue this journey with you. Tribe Hub, where financial empowerment begins. This session is powered by Tribe Hub, a place for all financial education, an initiative by Tribe to empower traders with knowledge, tools and community support to excel in the financial markets. Have you ever wondered why currencies react so sharply to bond market movements, or why changes in the yield curve can send ripple across the forex markets? Today we are diving into a fascinating topic of yield curves and uncovering their critical role in shaping currency valuation. So let's get started. Video part 1. In this section, we will going to understand what is yield and type of yield curves and some factors influencing the yield with currency valuation. The yield curve in forex is crucial as it provides insight into interest rates expectation and economic conditions influencing currency valuation. By analyzing yield curves, trader can anticipate shift in central bank policies, predict future market interest rates movement and identify potential trading opportunities. So what is yield curve? That is a big question, and many of the new players are not aware of this topic. So in simple terms, the yield curve is a graphical representation of the interest rate on debt for a range of maturities. Means what interest rate a particular debt instrument is attracting for a particular period of time. Let's say if you want to buy a car and you go to a bank and ask them that you need a loan for 12 months. Alright, so they will tell you that for 12 months the interest rate will be 12.5%. But if you ask them that you need a loan for 4 years, then that particular interest rate will gonna be changed, okay, because you are taking loan for longer period of time, so that they will reduce the interest rate a little bit. Alright, so this is how the yield curve also shows you that what is the interest rate level at a certain period of time. If you see this particular US government bonds 10-year yield chart, then it shows you that on the vertical scale you will see the percentage. This is the percentage on vertical scale, and on the horizontal scale this is time to maturity. Time to maturity means in how much period the bond will mature, the debt have to be repaid. So here you see that for shorter period of time, this is 1 month, 1 year and for 2 years. So you can see for 1 month the interest rate is around 4.30%, and for 1 year the interest rate is slightly reduced. It is around 1.150% only. And if you move further, if you go down the line towards 20 year of time, then you can see the interest rate has been risen a bit and it is around 4.80%. Alright, and this is 30 year down the line. It is attracting also around 4.70% of the interest rate. So this is what the curve means. This interest rate movement for different maturities, for 5 years, for 10 years and 30 years. If you are plotting it on chart, then it will gonna show you different types of curves, different shapes on the chart. Okay, we will explain it in the types of yield curves, but as of now I think we are clear about what is a yield curve. Interest rate chart that shows you that what is the percentage for different period of maturities. The curve may take different shapes at different points in the economic cycle, but it is typically upward sloping, indicating that longer term bonds have higher yields than short term bonds. This is normal yield curve reflect the expectation that investors require higher compensation for holding on to investments for a longer period due to the increased risk associated with the time, such as inflation risk or uncertainty about future interest rate. Why investors are asking for a higher return if they are giving you loan for a longer period of time? Because in a longer period the risk is very high. The risk for default, the risk for inflation, okay, the risk of economy taking a downturn. That is why, to compensate for that risk, any investor would ask you for a higher return. That is why the maturities with a wider period of time will have higher interest rates. That is why normal yield curve will be moving like this only, on the upside trajectory, because as you move higher and higher in the timeline, the curve shows higher interest rate. Okay, and any yield curve you are looking at will gonna be showing you that same type of bond with similar credit risk. Means whatever debt instrument they are talking about, the chart is talking about, will be of same type and will have similar risk category, and that is also being issued by same entity. It can be government or a statutory body. Alright, means the issuer is same, the category of risk is same, and the category of bond or any debt instrument will also gonna be same. So this is US government, the issued by US government, entity is government, and all of the 10-year maturities is the time period. Okay, and here we are talking about bonds. So that is why it is showing that all of the 10-year bonds will have this much of interest rate over a period of time. Alright, now that we have understood about what is yield curves, let's see what are some types of yield curves. So the first one is normal yield curve. Normal yield curve slopes upward, showing that long-term bonds have higher yield than short-term bonds. This reflects investors expecting of economic growth and inflation over time. It's the most common shape during stable economic market conditions. So you can see on this chart, on the vertical axis you can see the rate of interest, and on the horizontal axis you can see the time to maturity, means how many days or how many years are remaining for the bond to mature. Okay, and here on the vertical axis 5%, 10%, 15%, these are rate of interest. So if you want to conclude this chart, then it will be like this. Here let's say this is 1 year, this is 5 year, 10 year, 20 year and 30 year time to maturity. And if you look at this curve, this shows that the 1 year interest rate is just around 8%. If we move a little bit above in the time horizon, then you can see this is around 10% interest rate for 5-year bonds, and for 10-year bonds the interest rate is around 12%. So you can see the time is increasing, the duration for a debt is increasing, so the interest rate is also increasing. Why is that? Because anyone who is lending the money to the government or to anyone, he is expecting that if I am giving you loan for a higher duration, then I would need a higher return for that, because in the longer time period the risk associated with economy, associated with currency valuations or GDP data can be very much fluctuating, and I don't know what will gonna happen after 10 years. So I am taking a risk by giving you this loan. So that is why I need a higher amount of return for that. Okay, and you can see for 20 years bond it is around 14 to 15% of interest rate, and for 30 year it is around 16% or something. Okay, so you can see this normal yield curve, this is showing a stable economic condition. Okay, this is upward sloping, so that is why this is normal yield curve. So you need to remember that. What will be the impact of this type of scenario on the economy? You can see this is what typically you see when the economy is healthy. Investors demand more yield for locking their money up for a longer time. Alright, so let's see the next yield curve, inverted yield curve. An inverted yield curve slopes downward, indicating that short-term bonds offer higher yields than long-term bonds. This unusual shape often signals an impending recession, as investors expect the central bank to lower the interest rate in response to the economic troubles. You can see on this chart how the curve looks like. It is sloping downward from the upside. We have discussed in the previous curve chart that this is 1 year, 5 year, 10 year, 20 and 30 year time to maturity, and this is the interest rate on the vertical axis. So you can see for 1 year bonds the interest rate is very high, and for 5-year bonds the interest rate has declined a little bit, means whoever is lending money is getting less interest rate if they are lending for a longer period of time. And as usual you can see the 20-year period offers much lower interest rate than the 1 year or 5-year maturity bonds. So this is inverted. It means that longer period investments are not that much lucrative, and that is why investors are not that much interested in taking these maturities as an investment option. And if you look at the economy is showing a warning signal. Historically, every US recession in the past 50 years was preceded by an inverted yield curve. It's a red flag for traders to watch closely. Means the economy is somehow going into a slowdown or towards a recession, and if the economy is slowing down, then of course its currency valuation will also gonna be depreciating in the near future, so that have direct impact on the forex market. Let's see the next one, which is flat yield curve. Flat yield curve shows little difference in yields between short-term and long-term bonds. So the interest rates are pretty much similar for each and every maturity here. This usually happens during periods of economic uncertainty where markets are unsure about future growth or inflation. So the investors are unable to predict the actual inflation or growth rate. So that is why they are willing to invest, but the flat curve offers a reasonably low interest rate, right? Because this is an indecision mode going on in the economy itself. If you look at the chart, then all of the maturities are having a same or similar interest rate. It doesn't matter if you are investing for 1 year, 5 year or 20 year or even 30 years. The interest rate you will gonna be earning will be same for each and every maturity. Okay, and what will be the impact of this situation on the economy? It shows a transition phase where the market is waiting for clarity. As I said before, it's a indecision mode, whether that's a recovery or a downturn. So the market is as of now uncertain. Alright, so these three are the major type of yield curves. One more yield curve is there, which is like this. So we just draw a vertical axis and horizontal. So this is maturity and this is interest rate. in percentage. Alright, what happens here is that near term maturities will have a low interest rate, but the medium term maturities will have higher interest rate, and then again the long term interest rates will be similar to the short term interest rate. So the mid term offers good interest rate, but again the long term bonds will be offering a reasonable interest rate only. So we call this curve as humped curve. This humped curve shows that the medium term is predictable, but as of now the long term is pretty much uncertain. Alright, now that we have understood the basics of yield curve, let's explore its crucial role in forex market. The bond market and forex market are deeply interconnected, with bond yields serving as a key driver of currency valuation. So let's see how they are interconnected and we can use them. Interest rate movements. Interest rates and bonds. Interest rates are critical component of bond prices and yields. They have an inverse relationship. When interest rate rises, the price of existing bonds typically fall. When interest rate falls, the prices of existing bonds rises. This is because new bonds issued at higher interest rate are more attractive to investors, reducing the value of older bonds with lower rates. So what will be the impact of this scenario on bond prices? If bond has a fixed coupon rate, its price must adjust to match the current interest rate environment. For example, if interest rate increases, the bond price will decrease to yield a return comparable to newly issued bonds. And also we are discussing about yield for a bit now. But what is yield? Yield of a bond is the return an investor expects if the bond is held to maturity. As bond prices fluctuate due to change in interest rate, the yield adjusts accordingly. The second factor is central bank policies. Central banks like Federal Reserve or European Central Bank influence interest rates through monetary policy decisions. They may rise or reduce the interest rate to control inflation and stabilize the economy. When central bank rises the interest rate, they aim to cool down an overheating economy and curb inflation. Conversely, when they lower interest rate, they aim to stimulate economic activity by making borrowing cheaper. Now, what are the factors influencing bond yields? First is inflation. Investors demand higher yields on bond when they expect higher inflation. This is because inflation reduces the purchasing power of future interest payments. So, higher yield compensate for this loss. If I am investing 1 lakh rupees in particular government bond at an interest rate of 4%, but I see that for the next 5 years the inflation will gonna be rising by 6%, then I would need a higher yield on my bond to compensate for that inflation rise. Otherwise, I won't be able to make my expected return on that 4% interest rate. Okay, and you can know the inflation by studying CPI, Consumer Price Index, and PPI, Producer Price Index. You can closely watch these two indexes. They will provide you insights into inflation trends. Rising inflation expectation typically leads to higher bond yields. Second influencing factor is economic growth. Strong economic growth increases the demand for capital as businesses seeks to expand and invest. This heightened demand can push bond yields higher. And also GDP reports. Gross domestic products reports are key indicators of economic growth. Positive GDP growth can lead to higher yields, while slowing economy can result in lower yields. The third factor is central bank policies. Central bank influence bond yields through their monetary policy decision such as setting interest rate and conducting open market operations. Rate cuts or rate hikes are one of its part, and market sentiments. Market sentiments and risk aversion. During periods of economic uncertainty or market stress, investors seek safe haven assets like government bonds, driving yields lower. In risk-on environments, investors are more willing to take risk, which can lead to higher yields. Geopolitical events are one of the influencing factor, and supply and demand also have a very big impact on the yields a bond is generating. Alright, so these are some factors. Now let's see what will be the impact of bond yield curve on Forex market. First is currency valuations. Changes in bond yield can influence currency valuation. Higher yields attract foreign investors seeking better return, leading to an appreciation of the currency. Next one is interest rate differentials. Change in interest rate, or you can say the difference in interest rate between two countries, is the key driver of currency movement. For example, if US Treasury yields rises while Japan government bond yield remains same, the interest rate differential between the US and Japan widens. This can lead to an appreciation of USD against JPY as investors seek higher return in US bonds. Alright, so next one is capital flows. Movement in bond yields can lead to significant capital flows between countries, and conversely, lower yields can result in capital outflows, weakening the currency. For example, if US bond yield rises, the foreign investors might buy US bonds, leading to an appreciation of the US dollar. Few more factors are there is safe haven currencies in times of market uncertainty. Investors and we also want to put our investment into safe havens like USD, JPY, CHF. So if we are interested in investing in USD, then of course the currency will appreciate. Then the market sentiment, risk on market sentiments, it plays a crucial role in currency movements. During period of uncertainty, investors are more willing to take on risk, leading to stronger currencies in emerging markets and higher yielding currencies. In contrast, during risk off periods, investor seeks safe havens asset, strengthening currencies like USD and JPY. This is basic human nature for all of us, and geopolitical events also have a higher impact on the bond yield and the currency movement. So it can be anything like elections, trade tensions, or geopolitical conflicts can impact market sentiment. It can influence bond yields and currency valuation. Alright, and central bank policies, we have discussed about that a lot of time. So central bank also affect the forex markets. Now that we have understand the yield curve and its connection to forex dynamics, it's time to get practical. In this section, we will cover actionable strategies to trade forex based on yield curve shifts. Focus on real-world scenarios and tools that can help you make informed trading decisions. So let's start. Before you can trade yield curve shifts effectively, you need to monitor them like a pro. This involves understanding where to look, what tools to use, and how to interpret the changes. Thankfully, modern tools make it easy to track yield curves and bond market movements in real time. Here are some of the best resources for monitoring yield curves. Yield curves, charts and platforms. You can use TradingView to see interactive bond yield charts with customizable overlays for identifying the current market scenarios, or you can use similar terminals like Bloomberg, investing.com to identify major economic activities too. And you can refer to central bank websites like Federal Reserve for US, European Central Bank for Europe's bond yields, and Bank of Japan website. They regularly publishes all of these charts and data on bond yield trends. And you can also look for official data releases like speeches from governor or press conferences. They also contains vital information that can influence a particular currency. And in the end, you should use economic calendars. We also have economic calendar on Tribe's website, and you can use any other economic calendar you like to track key microeconomic events such as interest rate announcements, inflation reports and employment data, which directly affect yield curves. Now, once you have gathered the data, the next step is to understand what the changes mean and how they could affect Forex market. So let's quickly do a overview of which kind of yield curve shows what is the economic condition. So the first one is steepening yield curve. Steepening yield curve, it indicates a rising long-term yields compared to short-term yields. It often signals expectation of economic growth, inflation and potentially higher interest rate. Forex impact will be high yield currencies like USD, Australian dollar or New Zealand dollar may strengthen as investors seeks higher return. The next one is flattening yield curve. Flattening yield curve shows that long-term and short-term interest rate are same and the economy is in some kind of uncertainty. It is waiting for a recovery or a slowdown. It's a middle phase between steepening curve and inverted curve. The inverted curve looks like this. It shows that short-term yields are higher and long-term yields are much lower. It is signaling a recession or a slowdown in the economy. The Forex impact will be currencies tied to strong economies, USD or JPY may benefit while risk sensitive currencies can weaken. When monitoring yield curves, here are some critical indicators you should focus on. First one is 10-year versus 2-year yield spread. This is the most popular spread for identifying curve steepening or flattening. A narrow spread, as you can see on this chart, this shows that 10-year and 2-year bond yields have 0.33% difference, means there is a 0.33% spread is there. Alright, so let's see what is the meaning of this spread. A narrow spread is often a precursor to an economic slowdown, while a widening spread signals growth. As you can see, the spread was much lower earlier, but as of now in the current market situation, it is widening. When the curve is narrowing, means it's falling, then it will gonna show you a less growth or some kind of slowdown in the economy. But if it is rising and it is widening, then it shows that growth is on the way. The 10-year versus 2-year treasury yield spread is difference between the 10-year treasury rate and 2-year treasury rate. So when this spread chart approaches 0, it signifies a flattening yield curve, and a negative spread when it falls below 0 level, it has shown historically as a precursor to a recessionary period. And this 10-year versus 2-year yield spread also been identified as a leading indicator to that shows economic slowdown or growth 6 to 12 months before. Second indicator you need to track is policy driven yields. It refers to movement in bond yields that are influenced by central banks' actions and policies. These yields, especially at the short end of the curve, example 2-month or 2-year bond, are directly shaped by monetary policy decisions such as interest rate change, quantitative easing or tightening. For forex trader, understanding these yields is critical because they determine currency strength and investor sentiment. Focusing on the short end of the curve to gauge central bank's expectation. Long-term yields like 10-year or 30-year, they reflect investor sentiment about future growth and inflation. In short, if you want to predict the central bank's policy or get benefited from those changes, you have to track the short-term interest rate changes or short-term bond yields. They will gonna show you what will be the action of central bank and what will be its impact on the forex currency. Moving ahead, let's talk about practical trading strategies. So the first strategy we are going to discuss is trading the carry trade with yield spread. The carry trade is one of the most popular forex strategies, and yield spreads play a critical role in its success. It involves borrowing in a low yielding currency and investing in a high yielding currency to profit from the interest rate differentials. When combined with yield spreads, this strategy become even more robust, allowing traders to align their trades with global bond market trends. For example, if interest rate in Japan is 0.1% and the interest rate in Australia is 3.5%, you can borrow in Japanese yen and invest in Australian dollar to earn 3.4% differential annually. Alright, so this is how this carry trade works. But after initiating this carry trade, you need to monitor yield spread trends regularly. If the yield spread is widening, that will gonna indicate that high yielding currency is becoming more attractive. Example, if US 10-year versus 2-year yield spread widens compared to Japan, then USD JPY become a strong carry trade opportunity. And if the yield spread is narrowing, it will gonna signal reduced attractiveness of the high yielding currency. Consider it exiting or avoiding initiating new carry trades in such cases. Alright, so what will be the steps to execute a carry trade with yield spread? First is you need to identify suitable currency pairs. Look for pairs with clear yield differentials and widening spread. Examples: AUD JPY, New Zealand dollars versus JPY, USD versus CHF. So these currency pairs have one currency with high yield spread and second currency with low yielding spreads. Second step is analyze the yield spread. You can use any tool that we have discussed before. You can use TradingView, Bloomberg or any micro data website to identify the yield and then plot those charts to identify the yield spread. Then you have to verify with macroeconomics trend. Check central bank's policies to ensure that high yielding currencies interest rate are likely to elevated. Avoid pairs where the low yield currency is expected to hike rate soon. Alright, so these are some things you need to be aware of. Fourth step is to use technical analysis for entry points, because all of this fundamental are showing you why, but technical analysis will gonna show you how you can do a particular thing. So first thing is use technical analysis, and in that identify support levels for high yielding currency or resistance levels for low yielding currencies. Confirm bullish trends using indicators like RSI or MACD. Next step is set risk management parameters after your entry. So setting stop losses and your target orders will be a rational activity to do, so that can help you protect against adverse price movement. Monitor geopolitical events and economic events that could disrupt the yield spread or the forex pair. So after you have have set your post trade activities in effect, then you will achieve maximum profitability out of that. So let's see what are some examples of carry trade with the help of yield spread analysis. You can see this US versus Japan 10-year bond yield spread. On the left hand side you will see the interest rate, and on the right hand side you will see the exchange rate for USD JPY currency pair. So what is the correlation and what does this chart actually show? This blue color line plotted on this chart shows that the yield spread is rising. The yield spread is widening here, and the USD JPY exchange rate is in red color line, and it shows that US dollar is strengthening, and this is a reversed y-axis, so that is why it is falling. But if you just look at it on the correct axis, then it will gonna also be on the upside trajectory only. And if we look at the USD JPY chart, it also shows that it have a very good upside momentum. So this is from 10th of December this reversal occurred, when this yield spread started to rise up from this point. This is also around 10th of December. So you can see here in both of these two charts, they show a direct relationship between bond yields and the currency valuation. If you just summarize both of this chart, this will be the movement in the yield spread can reflect market sentiment and economic outlook for the US and Japan markets. Changes in central bank policies, inflation expectation, economic growth influence these spread. So that is why you need to keep track of those events very closely. Second example is British pound versus US dollar on one-day chart. It shows that GBP USD is having a hard time and it is moving in a downtrend as of now. And if you just see the UK versus US 10-year yield spread, then you can see the yield spread is falling. The UK US 10-year yield spread in blue color line, it is falling, and also it is some kind of flat as of now. And at the same time the GBP USD returns are also declining. This downtrend suggests a shift where the US economy might have been catching up or outperforming the UK economy, causing the GBP to depreciate relative to US dollar. Next is trend following strategy. Trend following is one of the most popular trading strategies in Forex, and combining it with yield analysis can enhance its effectiveness. By integrating bond yields with Forex market movements, traders can align their strategies with microeconomic fundamentals and capitalize on long-term trends. So this is basic. We are trading with trend following setups, but we are using a confluence of factors with the help of bond yields. As you can see, this is USD versus Canadian dollar chart on weekly time frame, and it shows that it is moving in a very good uptrend with reasonable retracements and ranges. So here at the bottom of the chart you can see this 10-year bond yield spread. It shows that the spread is continuously rising, so that US dollar is also strengthening, alright, and the Canadian 10-year government bond yield slipped below 3.23% because of concerns of slowdown in economic growth and persistent inflation pressure. All of these factors have triggered a down move in Canadian currency, and on the other hand side the US bond yields were looking very attractive, so the US dollar is strengthening. As you can see on this chart also, it has given multiple opportunities to enter with the help of breakouts and retracement entries, so that with the help of technical analysis and some trend following indicators, and by looking at the bond yield spread, you can initiate good trades in Forex market. Now, what are some advantages of including bond yields with Forex trading? First is interest rate and expectation. Yield curve provides valuable insights into market expectations. So you can gauge the sentiment or any potential shift in monetary policy. Second one is economic indicators. Yield curves are considered as leading indicator of economic conditions. If there is any slowdown is coming in, or any steepness or any recovery is coming in the economy, then these yield curves can show you in advance. They are leading indicators. Second is risk assessment. With the help of yield curves, you can assess the fixed income investment risk, and by comparing yield across different maturities, you can evaluate the relative risk associated with short term versus long term, or one currency to another currency, which will be much more beneficial, and then you can adjust your portfolio accordingly. But there are some risks also. So first is predictive limitations. While yield curves are valuable indicators, but they have some limitations in predicting future economic and market condition accurately. So word by word, you cannot expect it to perform as you have expected, but you can identify similar historical patterns and then use it in probabilistic way. Third is assumption of rational markets. Yield curve works best with the assumption of efficient and rational market, but we know that the markets are dynamic and they are influenced by many factors. It can be policies, news events, natural disasters, many things. Alright, or there are some manipulation also going on. So that is why you need to consider that chance of error while using yield curve analysis and central bank interventions. Interest rate change or any short-term change in policy can disrupt the yield curve signal, so that the yield curve can also provide you incorrect information. So that is why you need to be very concrete in your research before you take any big trading decisions. Alright, so these are some risks, and the best thing is to do is combine multiple confluence of factors to obtain a good edge in the market. If you are combining fundamental analysis, technical analysis and risk management tools, and then looking at the yield curves to confirm your analysis, will gonna enhance the probability and your trading experience in the Forex market. So that is all. We will gonna cover more strategies related to bond yield in our upcoming videos. Make sure to subscribe to our community channels to stay updated. Thanks for sticking around. If you have found this video helpful, there's plenty more to come in our series on Forex and technical analysis. And don't forget, for all your trading needs, visit tribe.com. For more in-depth trading education, head over to tribehub.com. Thanks for watching, happy trading, and I will see you in the next video.